Are you waiting for the tech world to be shaken by an explosive Apple earnings report? Brace yourself because the anticipation is soaring. Apple, the trailblazer in the tech industry, is set to unveil its highly anticipated earnings, and the excitement is palpable. With its remarkable growth and unparalleled reputation, Apple has left an indelible mark on the world of technology. The stage is set, the numbers are in, and the world is holding its breath. There have been high expectations from Wall Street analysts for Apple's Q3 2023 earnings report. Based on its projections, the company is estimated to achieve a revenue of $74.2 billion and earnings per share of $1.09. The optimism stems from the anticipated continued strength in iPhone and services businesses. Apple's iPhone sales are expected to remain resilient, with a clear uptick in demand observed in the crucial Chinese market. This growth in iPhone revenue is expected to be supported by higher average selling prices and increased upgrade activity for the iPhone Pro 14 model. Moreover, Apple's services segment is projected to grow, driven by its diverse offerings and potential acceleration in advertising revenue. However, concerns linger regarding iPhone demand in China and the expansion into emerging markets. China's economic reopening after the pandemic has been challenging, raising questions about how strong the demand for iPhones will be in the region. Additionally, Apple's push to enter emerging markets like India raises uncertainty about its success in these new territories. Other prominent analysts have weighed in on Apple's Q3 2023 earnings estimates, and their insights reveal a mix of optimism and cautiousness. Wedbush, for instance, holds an optimistic view, stating that Apple could flex the muscles in the upcoming report. They believe the demand for the iPhone 14 Pro in China has seen a clear uptick, which could lead to a potential upside for iPhone revenues in the region. With a highly anticipated iPhone 15 launch expected in September, Wedbush also foresees a steadier transition from iPhone 14 to iPhone 15. This indicates positive momentum for future sales. JP Morgan sees Apple as a resilient earnings compounder, believing that the company will drive higher confidence from the upcoming earnings report. They expect investors to gain further conviction in the resilience of the replacement cycle drivers for Apple's hardware products and the diversified growth drivers in services. The return of revenue growth on a year-over-year basis in the September quarter is expected to reinforce this view. Goldman Sachs highlights the factors driving an EPS beat for Apple. Their focus lies on the Mac and services segments, both poised for growth. They believe Apple's growing iPhone install base will lead to increased monetization per user, driven by average selling price increases and favorable industry tailwinds. This, along with strong visibility into future growth, supports a premium valuation for the company. Deutsche Bank holds a positive outlook for Q3 results, anticipating them to align with or slightly better than Wall Street estimates. They see potential upsides for iPhone, Mac, and services, believing Apple could still see growth despite the street's expectation of a 5% year-on-year decline in iPhone sales. The bank also raised its price target for Apple, reflecting confidence in the company's high-quality earnings and strong financial position. On the other hand, Piper Sandler takes a more cautious stance for Q3 results, expecting Apple to narrowly miss the Wall Street revenue estimate. However, they highlight positive momentum for iPhone in China, with citizens choosing iPhones over Android devices. Piper Sandler looks forward to the September quarter, anticipating gaining meaningful share for the iPhone and projecting a return to double-digit growth for services. TD Cowen forecasts a 2% year-on-year revenue decline for Q3, with some of Apple's product lines enduring muted seasonality. However, they see services primed for future double-digit growth, thanks to Apple's expertise in AI and the use of the Neural Engine. But before we continue, we want to thank you for watching this far. Now, let's talk about AI. According to reports, Apple has been developing its own ChatGPT rival based on generative AI, a technology that trains software to create new content in response to user prompts. This AI tool, dubbed Apple GPT, is used internally by employees for prototyping and data analysis. While Apple's plans for bringing generative AI to customers remain undisclosed, this technology has potential applications. One possible application is enhancing Siri, Apple's voice assistant. By leveraging generative AI, Siri could become more conversational and capable of handling more complex tasks. For instance, it could write emails on users' behalf through voice-based instructions. This advancement could greatly improve user experience and efficiency. Another area where the ChatGPT rival could be useful is improving customer support. By utilizing generative AI, Apple could enhance its AppleCare support staff's ability to assist customers more effectively, providing quicker and more accurate responses to queries and issues. CEO Tim Cook, however, takes a cautious approach toward AI and emphasizes the importance of being deliberate and thoughtful in its implementation. He acknowledges the need to consider various AI concerns, such as privacy, bias, misinformation, etc. Apple seems to be treading carefully and evaluating all aspects before making significant AI-related announcements. Moreover, it's worth noting that Apple's approach to innovation has also been inspired by Tesla, the electric vehicle manufacturer. While unrelated to ChatGPT, Apple has taken cues from Tesla's success in creating a dedicated fan base and a strong brand identity. Like Tesla, Apple aims to build a loyal customer base and invests in research and development to bring innovative products to market, creating a lasting impact in the tech world. On August 3rd, Apple reported revenue of $81.4 billion for the third quarter of 2023, a whopping 36% increase from the same quarter last year. That's right, 36%. That's insane growth for a company of this size and maturity. And not only that, but they also reported earnings per share of $1.30, which is double what they earned in the same quarter last year. That means they made twice as much profit per share as they did last year. How did they do that? Well, let me tell you. The main driver of Apple's revenue growth was the iPhone, which grew 50% year over year to $39.6 billion. That's almost half of their total revenue. The iPhone 13, which was launched in September 2022, was a huge hit among consumers thanks to its improved design, camera, battery life, and performance. The iPhone 13 also supported 5G networks, which boosted the demand for upgrades in markets like China and the US. Apple also benefited from the loyal and satisfied customer base that they have built over the years, who are willing to pay a premium for their products and services. Speaking of services, Apple also reported a record high revenue of $17.5 billion from their services segment, which grew 33% year over year. This segment includes things like Apple Music, Apple TV+, iCloud, Apple Arcade, Apple Pay, and more. These services provide recurring revenue for Apple and increase the stickiness of their ecosystem. They also have high margins and low costs compared to their hardware products. Apple has been investing heavily in expanding and improving their services offerings, especially in areas like streaming video and gaming. But wait, there's more. Apple also reported strong growth in their other product categories, such as iPad, Mac, wearables, home, and accessories. These products grew 12%, 16%, 36%, and 40% year over year, respectively. These products complement the iPhone and provide additional value and functionality for customers. They also showcase Apple's innovation and creativity in different domains and markets. The company posted an EPS of $1.26, higher than the estimated $1.19, and a revenue of $81.8 billion, slightly above the estimated $81.69 billion. However, the revenue was down 1% year over year, as the company faced challenges in its iPhone, Mac, and iPad segments. The iPhone revenue was $39.67 billion, down 2% year over year and below the estimated $39.91 billion. The Mac revenue was $6.84 billion, down 7% year over year and above the estimated $6.62 billion. The iPad revenue was $5.79 billion, down 20% year over year and below the estimated $6.41 billion. The global chip shortage and the pandemic impacted the supply and demand of these products. On the other hand, the company saw growth in its other products and services segments. The other products revenue, which includes devices like Apple Watch, AirPods, and HomePod, was $8.28 billion, up 2% year over year and slightly below the estimated $8.39 billion. The services revenue, which includes offerings like Apple Music, Apple TV+, iCloud, and Apple Pay, was $21.21 billion, up 8% year over year and above the estimated $20.76 billion. These segments provided recurring and diversified income for the company. Apple's gross margin also improved to 44.5%, higher than the estimated 44.2%, indicating its pricing power and efficiency. But does this mean that Apple's stock is doomed or overvalued? Not at all. In fact, I think that Apple's stock is still a great buy and hold for the long term. Here are some reasons why. First of all, Apple's fundamentals are still solid and impressive. The company has a loyal and growing customer base, a substantial and diversified product portfolio, a robust and profitable services segment, a huge and loyal cash flow, and a visionary and capable leadership team. These factors give Apple a competitive edge and a moat in the tech industry. Second of all, Apple's valuation is still reasonable and attractive. The company has a trailing 12-month price-to-earnings ratio of 32.66, which is lower than the industry average of 37.54. The company also has a forward dividend yield of 0.5%, which is higher than the industry average of 0.28%. These metrics indicate that Apple's stock is not overpriced or overhyped, but rather undervalued or underappreciated. Third of all, Apple's future prospects are still bright and exciting. The company has many opportunities and catalysts for growth and innovation in the coming years. For example, Apple is rumored to be working on new products and services such as augmented reality glasses, electric vehicles, healthcare devices, and more. These products and services could open up new markets and revenue streams for Apple and enhance its brand image and reputation. So what's my verdict? I think that Apple stock is a buy and hold for the long term. I think that the current dip is a temporary setback or correction that will soon be overcome by the company's strong fundamentals and future potential. I think that Apple stock will bounce back and reach new highs in the near future. But hey, that's just my opinion. I'm not a financial advisor or an expert. You should do your own research and analysis before making any investment decisions. And remember, don't invest more than you can afford to lose. That's it for today's video. I hope you enjoyed it and learned something new. If you did, please hit the like button, subscribe to my channel, and share this video with your friends. And let me know in the comments below what you think about Apple's stock performance and earnings report. Do you agree or disagree with me? Do you own or plan to buy any Apple shares? I'd love to hear from you. Let us know what you think in the comments section below. And while you're at it, make sure to smash the like and subscribe buttons down below. Additionally, if you're interested in knowing more about AI, I highly recommend watching this amazing video. Just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.